Brace the rudders! Raise the sails! Raise the sails!
Captain, an unidentified ship is approaching. Over.
Roger. Wait, is that an enterprise sales solution?
Reach sales professionals, not professional sailors. With LinkedIn ads, you can target the right people by industry, job title, and more. We'll even give you a $100 credit on your next campaign. Get started today at linkedin.com/results. Terms and conditions apply.
Reality radio for a really great future. We're talking real money.
You know, sometimes I just hate Wall Street. I just really hate them. I hate the things they do. They just go to too much trouble to make things too confusing and too complicated. And I don't know that they add any value in the process, except to themselves. Hi, everybody. Welcome to Talking Real Money, the Ranting Don Show, along with Tom the Unranter. He's just calm.
I'm the enchanter, not the unranter.
I'm the ranter, and he's the enchanter.
I love that.
And today, as every day, we're here to cut through the noise, the confusion, the complication, the expense, the misleading nature of so much of the financial services industry, and try to make it so simple.
To keep you from making mistakes.
That even a Homo sapiens can do it.
Yeah.
Yeah. Today we want to talk about, well, complicated investment products. Things that lay on top of simple investments, complexity to try to accomplish something that can probably be more easily accomplished for less money and less frustration. I mean,
Yeah.
is that accurate?
I think that's accurate. And what we're talking about today is structured equity products.
Just even the name makes me crazy.
Yeah, synthetic investment instruments.
Oh, see, that one makes me even more crazy.
Specifically designed to appeal to needs that investors perceived are not met by available securities. This is the part that that Wall Street says they're not met, but when you
What is it we're not meeting? What?
They're packaged as asset allocation tools, and this is from Larry Swedroe, by the way, that can be used to reduce portfolio risk. And by the way, you can go read all Larry's stuff free at his Substack account. It's all there.
You have to explain to people what the heck a Substack is.
I don't think I know. Structured, it's a place I read stuff.
So you give the advice and you don't even know where the heck to tell people to go.
I don't know. Type in Larry Swedroe Substack. It'll show up, I think.
Will it? Okay.
Structured equity products usually consist of an equity index. I think that's the thing you just mentioned a minute ago, right?
Yeah.
And a derivative.
Okay.
Options can also be used.
Yeah. Okay.
Yeah. So all these, you called them correctly, overlays. Things that they put on top of them. And here's the reason that we're talking about this today is because I just talked to somebody recently who's working with an advisor who uses these products. And he was like, well, why would this advisor recommend, and the expense ratios are very high. The performance is less than he would have made in an index fund. And you're buying that, right? The idea is you're protecting yourself from that.
Right? Exactly. That's a selling point.
Exactly.
You pay more and you make less.
And he didn't like
It's
that.
a good thing.
I think, and he didn't like the complexity. He didn't like the cost. But here's the reason we're talking about him. As of the end of February of this year, $234 billion with a B are in these types of products. People are buying them because they get the messaging of what I just said. Mm-hmm. It's what you've always said about equity index annuities. You get the return of the market with none of the downside. Well, baloney.
Not baloney. You get a market-like return.
That's fair.
But not the return of the market, and that's where the pitch is the problem.
And there's all kinds of studies that Larry cites that you could go in and read about the performance. Yeah, these funds delivered lower returns than but they did have smaller drawdowns, right? That's kind of, but the point was you can get the same thing by your stock to bond mix and you get it at a lower cost.
A lot lower cost.
Yeah. I mean, these are significantly expensive. There's another author that wrote a study called Engineering Lemons that looked at 21,000 products, found that investors paid 7% on average in annual fees and lost 7% a year relative to risk-adjusted benchmark returns. In other words, if you just built the appropriate risk-adjusted portfolio between stocks and bonds, you not only did okay, you paid a whole lot less in fees. So I don't want to spend too much time on the product. I know you
I don't
do.
want to spend too much time on that product.
No.
I just read an article just today, an interview at Morningstar with Cliff Asness, who is the head of AQR funds, and this is a guy who plays the factor rules-based investing game. I think he really just pays lip service to it, because he is bringing out a new family of funds that are designed to do this. They're hedged, leveraged. They borrow money to reduce the volatility and
how much do they cost?
Well, they're brand new. I mean, they literally just came out. They don't have any track record at all. They came out into June, I think. But their expense ratio, I looked one of them up. Just one of them. Just one. 2.31% per year.
And that's the person that I just talked to this week said, that is outrageous. He wanted to know, by the way, why the advisor, I didn't get finished. Would the advisor use these because you're getting a kickback? And I said,
no,
probably
you can't
not.
Get a kickback.
But he said, so that means they just want to use them because they think they're doing something that's more special than just investing.
You have broken the code.
I think he did.
Because many investment advisors want you to believe
exactly
they have magical powers of perception and that they're only going to put you in the finest products, not these run-of-the-mill Vanguard funds or DFA or even Avantis. No. We're going to get you state-of-the-art, best possible thinking products because we're smarter than those other advisors. And, the funny thing is, I bet if you looked at that advisor's ADV Part 2, you'd find that in addition to the 2.3 for the funds, he's probably charging 1.5 for money management.
I think he's charging a little less than that, but I think that's fair. But what you said at the beginning. So
that's 3% or 3.5.
It gets to be pretty expensive. But then Larry this is Larry Swedroe again.
Larry at Substack. I looked him up.
Okay, you can just find him there.
He's Substacking.
Yeah, I think it's good. But see, he says, well, so what is the prudent for investors? What's the winner's game? I love his description because I think if you listen to this is everything you need to know really in less than a paragraph. A sound investment strategy should be grounded in peer-reviewed, right? That's where academics reviewed their other academics, academic research, not opinions or anecdotes. The overwhelming evidence is that markets are highly, though not perfectly, efficient. This means that most information is already reflected in prices, making it extremely difficult for active managers to consistently outperform after costs, right? As a result, the most effective approach is to avoid strategies that rely on security selection, right? That's picking stocks.
That's picking stocks.
Market timing, that's telling you when to be in
the right place at the right time.
Yep. And instead focus on systematic, transparent, and replicable strategies such as using index funds or quantitative factor-based approaches.
But you see, that's what AQR will tell you they're doing.
I think they will.
They'll say we're using a factor-based approach, which they do. But they're saying we're adding another layer on top of that that enables us to reduce the volatility based on some back-tested research we've done.
Yeah, but the research, again, when you read Larry cites numerous studies. He just doesn't just make a statement. He goes back and looks at people that study the actual performance of these things, is not only leave money on the table, but you did it at a far higher cost than just doing it with your normal trade-offs between stocks and bonds. Yeah. That's the point. So I love that paragraph. I love it because it also reduces mistakes, minimizes trading, avoid market timing, keeping costs low. And by the way, he doesn't even mention the other one that I think people forget, and that's tax efficiency. Very tax efficient to do it that way.
There's the other one that isn't mentioned. Your sanity.
That's always something to consider. And so I wanted to add a couple of my own because of what I've seen again this week around being diversified. Still too many of us believe diversification is the Standard & Poor's 500. That is not diversification. Yes, 65% today, and Don and I can argue about what that means in your portfolio. 65% of the value of companies is in the U.S. That means 35% is outside. So you should at least, in my mind, have 35% of your money invested overseas. And here's the part that most people are still not in. most have a tiny little sliver of a thing called emerging markets. And you should have 5, 6, 7, maybe more % of your equity exposure in emerging markets. By the way, a couple things about emerging markets. I think we mentioned this in a recent podcast, but I just read it again. Emerging markets beat the Standard & Poor's 500 by 370% in the 2000 to 2009 decade. 370%.
That was
Now,
a long time ago.
they've gotten creamed.
We don't remember that.
They've gotten creamed lately, but don't you want to know that? That's one. Number two, I find this fascinating. It was not that long ago when this great country had to go to Great Britain to borrow money to finance the debts that we had for the Civil War. We were considered an emerging market.
I knew you were going way back. You had to have been going way back. I'm going, not the Revolutionary War, because we couldn't borrow from them. They didn't like us.
Well, the French.
1812, no, that wouldn't have worked.
Exactly.
It must have been the Civil War.
Yeah, Civil War. But the thing is, that wasn't that long ago. I know it seems like a long time ago, but in the history of things, not really that long. And the point is, this country was an emerging market. We were a risk. People weren't sure where you're going to get your money back. So sometimes sprinkling a little bit of your money in those places that feels riskier does make sense. So yeah, have the right balance, pay attention to fees, and know your tax liabilities. After that, as we've said on many times on many shows, it don't matter that much.
And so it's been said many times, many shows, it don't matter very much.
Yeah. So thank you, Larry, for both of those pieces. So you can
and
just
thank you
go.
for your historical anecdotes, Mr. Historical Anecdote.
You knew that was coming, right?
You love your historical anecdotes. He's the king of the historical anecdote.
I have a lot of questions too. Should I ask some of those?
Are they historical?
There is one historical one here, so we'll get to it.
All right.
All right. Rich writes, says, "Hey guys, love the show. The Standard & Poor's 500 gets 28% of its revenue from other countries. Let's say I just have an S&P 500 index fund and some non-U.S. stock funds. How can I determine the ultimate amount of revenue my portfolio is gaining from U.S. versus non-U.S. operations? To put this another way, if I have 75% of my money in U.S. stock funds and 25% in non-U.S. stock funds, am I really experiencing a 25% non-U.S. experience?
Yes.
What you're really experiencing is you're experiencing overthinking things.
Yes.
By the way, there's another thing about this that comes up
How
regularly.
much of the international comes from U.S. money?
Thank you.
No, you're making it too complicated.
Way too complicated. But
it's your
people
U.S.
oftentimes,
international equity exposure, where they're based, where
many
they're
people
traded.
believe, because I think if Microsoft gets 40% of its revenues from overseas, that's my overseas exposure. No. You need to own those companies in those other economies and have your dollars redenominated in those other currencies.
Nestle probably gets over 50% of its revenue from the U.S.
because it makes the very best.
They're and they're a Swiss company.
Thank you. So the answer is, Rich, take it easy, invest internationally, and quit worrying about where the money's coming from.
Oreo cookies.
Who owns Oreo? I don't even know this.
Mondelez, which is a Mexican firm.
Didn't even know that. All right, John writes us from Baton Rouge, Louisiana. By the way, I'm watching the Katrina special now on National Geographic, and it is shocking.
That was really more New Orleans than Baton Rouge.
I know, you're right. Well, one guy was trying to get to Baton Rouge, and he ran out of gas, I think. Hard to watch. Retired this year at 79 with 457 traditional of $1 million and Roth of 30,000. 2 small pensions, 1 with survivor benefits, and 2 Social Security accounts equals 92,000. I assume that's the 2 pensions and the 2 Social Securities equals $90,000. Okay. Managed by Empower with assets at Schwab, primarily in Vanguard index funds and ETFs. Trying to transfer to Schwab and eliminate the middleman. Any advice? Yeah, you don't have to use Empower after you retire.
Yeah, you're done.
You just
can use
open an IRA or an Roth and move them right over.
Yep.
If you have a traditional 457, so the money would still be
easy,
at Schwab.
and you contact them, they'll do it for you.
Yeah, pretty easy. So, okay, hope we answered that one. I hope that was the question. I think it was.
If that's not the question, then call us on Saturdays at 855-935-TALK.
That's what I love about Saturday, because we get to unpack it a little bit more in a way that
within the constraints, the time constraints we have.
But it's still, we could really get to the bottom line better. All right, Reg writes us from Soquel, California. I don't know it. Soquel.
You're a Californian.
I know, but I don't know the place.
California.
I
If it's
know.
Colorado, you can call me on it.
You recently chided me for not knowing every town in the great state of Washington.
No. I chided you for good reason because you claim to know every town in the great state of Washington.
I did say that, yeah, and I was wrong. All right, recently I heard a vague reference to using IRA withdrawals to pay for medical expenses. Could you discuss the different ways that IRAs can be used for medical payments, the tax consequences, restrictions, and rules that must be followed? The time frame makes sense before 59 and a half after starting our... Okay, but let's just start with the basics. If you have a medical emergency that exceeds 7.5% of your adjusted income, then you can take money out of an IRA before 59 and a half and not pay the penalty. You're still going to pay the tax. You're going to pay the tax no matter what the circumstance to pay those medical benefits.
You just get out of the 10% penalty.
You get out of the 10% penalty. In terms of the RMDs, doesn't matter. Again, the RMDs have to be taken, people, unless you give the money away. That's it. There's no other way.
But if you take money out early for medical expenses, you're going to have smaller RMDs.
That's true.
Because there'll be less money there.
There will be. But again, it has to meet that standard, that number of 7.5 or more of your adjusted gross income. So it still has a benchmark to beat. So yeah,
and that's a pretty fair chunk of AGI. That's a big hurdle.
They don't want to give you that. In other words, right? That's what they're saying. But the people that wrote the code. So, Reg, I don't know that I'm answering your question because I don't know that I know what it is. Because
is there a sentence that is followed by a question mark?
Yes. Are there tax advantages to making medical payments directly from an IRA or versus personal funds? No.
There are no tax advantage. There are penalty advantages. I just want to make sure we answered the question.
Yeah.
The question was that, and there are no tax advantages.
Oh, he does mention later on medical expense deductions are limited. So then you wouldn't the 59, and he's older than 59 and a half. So that does not apply.
So it doesn't matter anymore.
No.
So there are no benefits to taking it out of your IRA.
No, you're going to take it out and pay whatever you like.
Right, just like you would taking it out of your brokerage account or whatever the tax situation is with that account doesn't change with medical.
Yep. This question comes from Mount Airy, North Carolina. Wasn't that on your trip one year, Mount Airy? No.
You know what Mount Airy is?
No.
Did you know the song?
Dun, 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 dun.
What's the song from?
Mayberry.
Andy Griffith's show.
Mayberry RFD.
Mount Airy was with Andy Griffith's from there. That's what he patterned Mayberry.
Speaking of going back for a story, good Lord, that's like the first year of television or something.
I think it was the fourth or fifth, but
okay. Angela writes us from Mount Airy, home of Mayberry RFD.
And Mayberry,
If I have the dividend set to not reinvest, am I messing up the favorable tax treatment you have stated for exchange-traded funds? The reason I had it set that way was to use dividends to buy more of the ETFs. I have smaller balances and gradually achieve a different mix. However, I noticed a relatively large cash dividend at the end of June and wondered if it would not have counted as a dividend for tax purposes if it had been reinvested. The short answer is don't matter whether you take the dividends or reinvest.
Yeah.
That's
dividends, any dividend that is a taxable distribution.
That's that.
Which in ETFs is almost always income. Could be, it's income.
Yeah.
That's always going to be taxable whether you reinvest or not. Period.
The tax advantage to being an exchange-traded fund has to do with capital gains inside of that fund.
Right.
In a mutual fund, you could have capital gains in a losing year, for example.
Because mutual funds are required to distribute most of their capital gains that they realize in the course of a year trading stocks. ETFs, on the other hand, because of the way they're structured, don't actually ever trade stocks.
They're in a big warehouse handing them from one party to another.
Yeah, they just move them within. I don't know how it works, but it's a better deal.
That's a big warehouse, by the way.
Well, it's all virtual. So it's like the Bitcoin warehouse.
Okay, I thought there was like a place.
No, it's like the Bitcoin warehouse.
Okay.
All the Bitcoin.
One big warehouse?
Wait, no, it's right here in this box. Here it is.
Okay.
See that box?
There's a $1 trillion box right there.
Fits in that box.
All right. Which is, I hope, where it stays, by the way. All right. David writes us from Fort Myers, Florida. I started listening to Don about 1993-ish.
When I got fired from Business Radio Network.
I thought it said 1883. I was getting a little nervous.
That was when I started at Disney.
He said he made sense, he says. I followed his principles, and now I'm 65. I'm writing to complain. No, I added that. Over the years, I came close the last 10 years, but never cracked 100,000. I'm retired at 59 and now have paid off my $500,000 home for 15 years. And I have an investment portfolio of $1.7 million, all done with no load, no fee mutual funds. Thank you, Don. I just threw that one in there because that was a nice comment.
Well done, sir.
Yeah, and this, by the way, is, I hope, going to be a topic on an upcoming podcast because, we're minting right now 1,000 new millionaires. I believe it's a day in America.
Wow.
Yeah. So I want to talk about
how. They have a
how.
mint for that? They have.
You actually
I
go
didn't
to a
know
place.
you could get like punched out in a.
It's
and
bigger than the Bitcoin box. Let's just put it that way.
bigger than the Bitcoin
So,
box.
so listen, David, thank you for that. And yeah, here's the part people forget. Sometimes you just have to start, right? You just start, you put something away and you start, but you got to do it right in the right funds, have the right mix. Don't worry about it every day and then ignore all the noise because they're going to come at you.
Yeah, and let me just say that my suggestions have changed over that
Oh, no. What? How have they changed?
40-year period.
Yeah.
I mean, I've always been a no-load guy, but I learned that active managers can't do anything, and so I modified my belief system based on funny little thing. When you learn stuff, they call them facts, and when you're faced with facts and you don't change your mind, to me that makes you kind of stupid.
Well, and going way back when you were a broker, you had a whole different set of beliefs.
Oh, I didn't have any. Oh, no.
You
I had
didn't have
no
a belief.
standards.
No belief.
I had no standards when I was a broker. I was 27 years old, and I was a dumb bunny. I was as naive as they come. They told me what to sell. They said, your job depends on it. Your future depends on it. Your paycheck depends on it. Go sell the stuff. So I went and sold the stuff. Didn't, in hindsight, the stuff I was selling was horrible.
And what were you selling?
Mutual funds with no front load and high expense ratios. And we were pushing a government plus fund back then that had that
That's
we got
a big
5%
government
commission
plus
on.
size fund?
It was using options to enhance yields on government bonds.
So making way more than you were just owning
and
the
it
bond
made
fund.
it more volatile. It made it more risky. I mean, we were selling limited partnerships. Public storage was hot back then. Public storage
So
partnerships.
you could buy an LP in public storage?
and own some public storage
Right.
buildings and get the
I wonder how that all turned out.
It didn't turn out horribly, but it
Yeah.
didn't turn out well.
It
Because
turned out
guess
well
who
for
made
the
most
people
of the money?
selling the product.
Yeah, that's
This is something
the
we
people who
talk
made
about.
most of the money.
And then you moved on to the radio business, and
Right.
you
I went-
did recommend mutual funds there.
Well, no, there was an interim step. I went from being a broker to being a general talk show host, like
That's right, you
political,
did. In,
political
Colorado.
talk show in
Yeah.
Colorado.
Yeah.
I went from making almost six figures in the mid 80s to making $500 a month at the radio station.
But you could trade out all the groceries you wanted.
But
at the
I
radio
did.
station.
I did trade for groceries. I sold ads to a
Imagine
grocery
how many
store.
diapers you could get for
I
trading
did,
out.
and I had babies too. so
I love
those
it.
diapers were important. Interesting road. And then BRN started Business Radio Network, and they went, God, we really need somebody who knows radio and money, and who lives in Colorado Springs. What are the odds we're going to find anyone?
They
tried to hire
one
the
guy.
Dolans.
Oh,
Remember
they
the
did.
Dolans?
Yeah, of course. Yeah.
Yeah, and they said, we're in New York. We're not coming to Colorado Springs.
Chicago, I think.
No, they were in New York.
Oh,
WOR.
I thought they were Chicago. Okay. Well,
Anyway, that's my story, and I'm
that's
sticking
your
with it.
story, and you're sticking with it. And thank you for the kind comment. And that's all the questions we have as well.
Look at that.
Yeah.
We're going to wrap this episode
I
up
know.
in record
I want to
time.
thank you all and keep them coming because we love talking about them. And keep calling us on Saturdays Live. And keep calling Don for the call-in question.
Yeah,
and
let's look and see how we're doing on call-in questions.
Keep asking us for help, which is just going to talkingrealmoney.com and then ask an advisor. So I've taken a lot of the
Meet an
meetings.
advisor.
I like asking advisors.
Every
Can you switch
week
that?
you get it wrong.
I know, but it still
Oh, my
works.
goodness.
currently.
Look at that. 1, I can't count Bob. 2, 3, 4, 5, 6,
No.
7, 8, 9,
Wow.
10, 11, 12, 13, 14.
You got some shows
spoken
ahead of you, my
questions.
friend. Yeah.
We're going to have some record numbers of questions in
love it.
upcoming Friday
Yeah.
shows.
It's good. Good.
That'll be this week. Yeah.
That will be. Yeah.
Okay.
All right.
All right.
Do it.
Are we good?
That's it.
Can we leave?
Ask an advisor.
Are you sure? You good?
No, I'm not. Meet an advisor. Contact an advisor.
Just final answer?
An advisor. Something on the website.
He's a very confused person, folks. Is Roxy there? Can we bring her in?
She's not here today, actually.
Roxy, come on.
Along with the rest of the staff. They're not here
Along
today.
with the rest of the staff. Isn't there an in-office requirement
I have
now?
no idea. You know that. I have no idea what's going on right outside
the less
this
he
door.
knows, the better.
I think so, frankly.
All right. Thank you for being a part of this. Please share
But
the
you're
show.
there. Thank you for that. Appreciate it.
I never leave.
No, I'm not talking about you. I'm talking about them.
Oh, the listeners?
Yeah, thank you for that.
They never leave.
They show up. I know.
Thousands of them.
I know.
Every day.
I know.
Thousands of them download our episodes,
That's
putting
very
us
kind.
well into the top 1% of all podcasts in the world.
Yeah.
In
that's
the
that's
world.
remarkable. And all joking aside, I'm grateful for that. Truly.
Me too.
I am. So.
Yeah. So thanks so much
Keeps us
for being
young,
there.
keeps us working. Or not
Go to
young, but working.
talkingrealmoney.com. You
Still
find
elderly.
stuff. Just scroll. Really, go to talkingrealmoney.com and just scroll up and down the page and punch buttons and look at things.
No,
There's
you're not
stuff-
supposed to punch any buttons, I thought.
Not you.
Oh, they can.
You
Not me.
are not allowed to touch buttons because every time you do, you mess something up. It's so funny. You and my wife both fear that. You're like you fear computers. You look at them and you go, if I touch something, I'm going to mess it up. Funny thing is it actually happens.
I'll tell you another funny story.
I can't mess up a computer. You can every time you touch one.
So I've been looking forward to the Katrina thing on National Geographic Channel, which is part of Disney, right?
Disney Plus,
I rarely
yeah.
go to Disney. So I went to Disney a couple of days ago, look for it. Not there. So then I went online, read when's it drop, and then it had dropped. So I got home yesterday, flipped it on, go to National Geographic, not there. And my brother and his wife and son are staying. So I was getting pissed. I'm like, where the damn? It says
Really?
it's on here.
You get upset with technology? Hard
It says
to
it's on here.
believe.
No, here's the part that's funny. So my nephew goes, it's on there. You don't know what you're doing. So he goes, the home
Wait,
page
who said
of
that?
My nephew. They go to the home page of Disney, and there it was. It was not at National Geographic, so I was not completely wrong, but I overlooked it. So it's there. You got to look for it. And I'm enjoying it. It's a good show.
You have to actually, just see it. Not really look for it. It's just like see it. It's there. It was right there in front of you, and you didn't see it.
I know. I get the message. Mm-hmm. That's enough.
It's Apple TV. It's really easy.
No, this is Disney TV.
No, but your device. And
right.
It's really so simple. Okay.
Click. Push buttons.
Thank you all. I'm going to put you out of your misery now and end this podcast. Take care of yourselves. We'll talk to you really soon. Go visit us at talkingrealmoney.com, and please tell a friend or two or 10 to try us out over the summer or the fall. Try listening to Talking Real Money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.